Tonight we're going to finish chapter 2 handout. I think we only got one problem in that to do, and then we're going to start in chapter 3. The chapter 2 and 3 tests will be combined. There'll be one problem off chapter 2, which will be a statutory consolidation where the company is dissolved, and then there's going to be a consolidation, which will be from chapter 3. Okay, let's see here. Let's finish up chapter 2. Okay, yeah. Oh, do we do this one? No. All right, so let's take a look here. So we're gonna see what excess we have for these. All right, so yeah, so these are the assets at fair value, and cash receivable is the same. Inventory looks like we need to put another 1,000 on, 2,000 on land. Looks like 3,000 on buildings. Okay, and let's figure out the goodwill. So goodwill would be basically, if you want to know the value of this company of the identified assets, which is kind of still kind of a funny word, but so the fair value. I should say net assets at fair value. We'll take the 58,000 minus the liability, which is 18,000. And by the way, just in real life, oh, hold on. Oftentimes the liabilities will be on the books at fair value. Okay, so asset at net fair value will be 58,000 minus 18,000 liabilities. And so that'll be 40,000. And these would be the identified assets. Make that assets. Okay, and the cash price we paid was that. So how much goodwill?
2,400.
And actually, we need to do it for this one because we're going to put it on the books. Do I have a count? I do have a place for it. You know what? I realize I don't have I think I did this last time. I don't have the speakers on or something, right? Give me 1 second. I can't remember what we did last time to get the speakers going.
Can they hear you?
Testing.
Can you hear me? Put it in chat if you can. Oh, wait, it's showing it going, but it's not doing anything. Can't hear it in here. It must be turned off.
Yeah, they keep.
I think they can hear me, but we can't hear them. That's the problem. I wonder if the TV is muted. Oh, volume.
Can anyone hear me?
Yeah, hear you now.
Yeah.
Can you hear? I think you can hear us now. Hello.
Yes.
Oh yeah.
Okay,
Perfect.
we can hear you.
Okay.
There's a delay, but okay. End test. Sorry about that. I was so excited about getting the camera, I forgot about the problem we had. All right, so yeah, the goodwill, I was gonna jump to it. The goodwill, so this is the price we paid for it. And these are the identified net assets. That's a term that the book uses, identified net assets. And so the goodwill will be the extra 2,400.
2,400, yeah. Mhm.
So the difference between those two. Ah, okay, so let's come down and let's start putting this stuff through here. So first thing we have to do is take off all of the, we're going by Sadie though, if you remember from last time. Sadie's all the way up here. I'm gonna copy Sadie down here. Well, actually, just the first two letters of Sadie is all we need for right now. Later on, we'll do all of them. Okay, Sadie. So stock and the additional paid in capital, we have to take that off. So we're coming here. Okay, okay, in capitals, 15,000. And retained earnings. Now, none of this is retained earnings. This is on the first of the year, right? And that's important because we'll also do it from the first of the year on the next one. When we go to the after 1 year of so this is 13. All right, so we have to take that out of the investment. $34. Yeah. So it's 34,000. And now we got to go through the assets. Now the assets. Nope. Yeah, that was. So these are the three assets we have to look at because they are the ones that have different fair values compared to equipment. Nope, equipment does not. Okay. So inventory, we're saying the fair value is 17,000. They have it at 16. So we're going to put that on the books as an additional 1,000. Land, we're saying is 14,000. They're saying it's 12. And buildings, 12,000 compared to 9,000. And so that will be 3,000. We have one more. Okay. They shouldn't. And that is what? Anyone? Goodwill. Goodwill is an asset. Okay, so that's 8,000. See, 6,000, 8,400. And in the wrong spot, yeah. How did we get it 8,400? It's in the wrong spot. It's coming out of investment. And 34, yeah, it'll wipe that one out. We got to get rid of this investment. I think I talked about this last time. This investment, if we simply took these two companies and smashed them together, bill company would be counted twice because we count all their assets and liabilities and all that, but we'd also count the investment. So we have to get rid of the investment. Furthermore, this outstanding stock is not outstanding. It's inside here. It's inside the parent company. Is it Amy? Amy. So we don't want to double count bill, and we don't want to have outstanding stock that's not outstanding. Okay, so we go here for the totals. And we're just adding these up. 10 plus 4, 14,000. I'm going to bold out. Hey, what's not going down? I can only pick one at a time. How's that fair? All right, well, okay, so 14,000. I know what I can do. Hold the whole thing. and goof up all my spacing. Okay, we won't do that. Oh, maybe it is letting me. Okay, 14,000. Receivables, 12 plus 3 is 15. Inventory. Wow. 20,000 plus 12 plus 2 is 34,000. And 4 plus 12 is 36,000. Plus 8 is 24,000. Okay, now, so this is the Amy company. These are all debits. We're crediting those for those two. So 42,000 minus 34. Okay, 42,400 minus 34,000 minus 8,400. I think that comes out to 0. Man, it is really cold in here. Okay, now I either forget about the goodwill when I'm putting it on, or I forget about the goodwill down here. Let's make sure I don't forget the goodwill. So the goodwill is that. Okay, let's add these all up. $7,400. Yep, should be right. Okay, coming down here, we have to add up the accounts payable and the bonds payable. 19,000. And 22 and what's that, 35,000? Okay, now this whole equity section here is gone. For good reason. This is not outstanding stock. Nobody has this. The only outstanding stock is here. So this is the only outstanding stock we'll have left. So it'll just be what the parent company has for outstanding stock, which is 18,000. And 26,000. And 72,400. So again, these are the same numbers as over there. It's the only stock that's outstanding. Now, hopefully this comes out to what we want it to. Oh, don't go to sleep now, phone. All right. Hey, it does. All right, so this is the combining it. And if you were to see this, all you would see, if you looked at the combined financial statements, all you'd see are these numbers, the consolidated. You wouldn't see these other ones individually. Now, usually companies will put out individual ones. For instance, Amy Company will have an individual one. Bill Company will have individual financial statements. It'll just come off of these, respectively, their two companies. But then when we consolidate them, they will look like this. They'll just all be together as a consolidated financial statements of Amy Company.
I have a question.
Mm-hmm.
For the financial statements up there in the preamble, is that for Army or that's for Bill? The one up there.
Yeah, the consolidated?
No, the one in the preamble, the one up, the financial statement up. Scroll up a little. Yeah, this.
These?
Yeah, is that for Army or Bill?
No, this is for Bill.
Bill. So Army is purchasing that, is consolidating that of Bill.
Mm-hmm.
And so they have to merge or they have to add all the funds together.
Correct.
So they add their assets and then their liabilities. But when it comes to the capital, we don't add it. Is that right?
Right, because this actually isn't outstanding anymore. Oops. This, the common stock, additional paid-in capital, all those shares, all that ownership is actually in the ownership of Amy Company.
Oh,
It's included in Amy's company. Yeah. Yeah, yeah. And the only stock that people can buy would be from Amy's company.
and what of the investment? I see you don't have investment. So
Yeah, the investment goes down to zero because if you think about it, this investment, this is the Bill Company. Oops, that's not. Hold on. So this is actually Bill. So if we were to leave this on the books, we would count all Bill's stuff and then we count Bill again because Bill's entire company is actually in this 42,400.
okay, so it's like in the long run, they both cancel out because if Army is purchasing Bill for 42,400
Mhm.
as an investment, it's going to cancel out in the equity side of the account.
Exactly,
Okay.
exactly. And yeah, and the difference is between these two are the equity side, the equity down here in this equity. So if you take 42, if you take 152,452,000 minus the 34, it should come out to the 170. I think I goofed that up last time. So 152,000.
And the goodwill is as a result of the investment we made minus the fair asset value.
Yeah, and the term that they use is for identifiable assets. Which to me is a little bit funny because you're identifying goodwill, but yeah, the identified assets. So in other words, the assets that they have on the books so far, I guess, is what they're talking about. That identified that there's something extra is the goodwill. Yeah.
Oh, understood.
Okay, let's see, minus, what did I say, 34,000? Yeah, it comes out. So if you're to take this stock, the stock of, the equity section of Bill Company out, these two minus the stock would be, or the equity section would be how we come up with the 170,400.
Oh.
Now the next thing we're gonna do though is go into chapter 3, which is what happens at the end of the year. And the only reason I'm bringing this up now is these retained earnings are as of the first of the year, we take them off the books. And so it's going to change a little bit when we go to the next problem. These are at the beginning of the year. I shouldn't do it in the same color as that. These are, and so we'll still have to take it off as of the beginning of whenever we purchased this thing. And I'll show you what I mean when we get to it, but it'll be taken off before it even gets to this equity section. Okay. All right, so this can be turned in. And again, let me put it right up here. The chapter 2 and chapter 3 exams will be combined. Oops. Actually, it's that there'll be a chapter 2 and chapter 3 exam is probably the better way to put it. That's not true either. Let's just say after chapter 3, because actually there's gonna be textbook problems. Oh, I know what I want to tell you guys. Wait a minute. Nope. Hey. All right. I did put a I haven't heard anything back from I've been emailing people and I haven't heard anything back. So as far as in the textbook, I'll show you what I did. Kind of a workaround thing.
Professor, when is the next exam due?
The next exam?
Yeah.
I'll probably send it out next week. Because next week we'll do there's a couple textbook problems I want to do. Yeah, hopefully we'll get to it by next week.
Okay.
But if you look at the ebook, there's one to sign into the ebook, but there's a second one to purchase it. And the ebook can be purchased for $77.33. I can't remember what the Laker bundle is, but I think it's close to that anyways. So this would be, if you want the ebook, it's there and now, and then here would be the sign in for it. Excuse me. And the reason I do that is we're not going to use the platform, the Connect. And so, and that adds another $80 or something onto it, and there's no reason for it. We don't need it. So anyway, but the textbook is there. It is a pretty good textbook. I do like it. The problems are almost all they need a little bit of cleaning up, but for the most part, it's the text part I think is very good. But that's every book. Anyway, okay, let's go ahead and so we can submit chapter 2 now. And let's go to chapter 3. Now, chapter 3, for those of you playing along at home, there's also an Excel version of it. If you want, that's a version I'm going to be using. But I sent it out. Let me check and make sure I put it in with the assignments. Did I put it in there? I did. Okay, good. Yeah, there is an Excel handout in there that you can use, and I'll be using that because it's just cleaner. And now I'm lost. Okay, let's go back to. All right, so I'm going to pull up the Excel version of it. And it's fairly similar to the other one. We have our Sadie. And now we're going to use all of Sadie. Okay, so we have problem 2. And let's take a look here. Kind of get our sea legs here. So this is for after the first year of operations. These are, notice the date on these. These are as of the first of the year. And if you come down here, you'll notice that these are at the end of the year. So this is after a year of operations. So Amy has her, her income is here. Bill has his income statement here. Actually, those are companies, so I guess they're not his and hers, they're theirs. But so these are the two. And again, they're doing their books completely separate. It's a separate entity. So Bill is chugging along just like they did before. They didn't change the value of their assets or anything because it's completely separate and they have to follow the accounting rules, and the accounting rules are, whatever they are. And so they can't write up assets and things like that. Okay, and here's Amy. So we have the income statement. We have the statement of retained earnings, and notice there's the important one. We have the beginning retained earnings. This is where we're going to take the retained earnings off the books, is in the statement of retained earnings. Statement of retained earnings is just you take your beginning retained earnings, you add in your income, that's how much they made, take out whatever they took out of the piggy bank. So retained earnings are kind of like a piggy bank. They start out with an amount in the piggy bank. They have net income that goes into the piggy bank. They take money out of the piggy bank, and whatever's left in the piggy bank is the ending. So money goes in, they take money out, and whatever's left over is what's left in the piggy bank. Balance sheets the same. I don't have these labeled. Well, I do. I have total assets, and then here's the liabilities down here. Does look strange though. It looks like I took something out of here, but I can't remember what. Okay, so let's see if we can get our self around this here. Okay. Oh, this is already done for us. Oh, this is good. Goody. This one will be fast. I think the next one it is not done for us. But anyway, you'll notice that the cash price we paid is 225,000. The net identifiable assets at fair value are 200,000. So how much should go into goodwill? Oh, you guys know this. You're toying with me.
25,000. 25, yeah.
Yep. So 25,000 will go into our goodwill. So identifiable assets, assets that are actually up here in the fair value column, those are identified, and the net of those is 200,000. So there must be something else, and that would be our goodwill of 25,000. The excess is given to us. It may or may not carry down to here. Let's take a look. I think I have it so it does, but let's see. We have land and buildings go up by 10,000, so 70. So what are those, 60? They don't have to. Yeah, so land is 60,000 and buildings are 45. And there's 65 here, so it's $20,000 more. It is possible for these to move around a little bit. I think I have this set up so that they would actually come out to be, I rigged it a little bit. Just because I'm an evil person. No, but because just to kind of show you where those come from, those excess. So Bill has them on the books for 60,000, but we're saying the fair value is 70, so it's an extra 10, excess is 10. And for buildings, the excess is 20,000. Bill says that they're on the books at 45,000, and we're saying, no, that's worth 65,000. So there's an excess of 20. Okay, so let's start. Are we ready to start walking this through? I think we are. Okay, so Sadie, I don't think I pasted that. So Sadie, I'm going to put Sadie over here. Actually, I'm going to put Sadie down here, closer to the investment. Okay, that didn't work. Why didn't that work? Hmm. Their notebook here. There we go, kind of. All right, well, it looks, Sadie looks kind of sad right now, but I think I'm not sure what's going on with Sadie here. Oh, I bet you money there's spacing in there. No, there's not. I'm not sure why Sadie's doing that, but we'll give Sadie a break here. Oh, I know what to do. No, it doesn't do anything. Man, is that weird? Well, anyway. So let's start going through here. So let's do the S as a stock. Okay, now the first two are going to be exactly the same as we did before. So it's going to be down here. And we're going to take off the common stock, 30,000. And 75,000. Now, this retained earnings, this is the ending retained earnings. This ending retained earnings is after a year of operation. We need to take off the beginning. Excuse me, when we bought this thing. So we're going to come up here to the beginning retained earnings and take it off up here. 65,000. So it's a little bit different than we did before, and it's a little bit spread out, which makes it harder to view. But yeah, it'll look like that. Okay, so fill color. We'll do this color. It's kind of well, you can hardly see that. Okay. Hope that's not too dark at home. You can't read it. It's hard to. The hardest part about consolidations is picking the right color. I'll do it like that. Okay, so there is the 65. There are those two, and we have to take those out of the stock. And I'm going to use the cell to add these up. Okay, so we're going to take 170 out of our investment. Almost invisible here. Well, maybe I should make them darker. Okay, I'll make them a little darker so we can see them. I'm not sure if it's her TV in here or if it's the, I don't know. Okay, so that is our Sadie, our S. And now we're gonna go to A, the assets. Okay, so the assets we have are these two. Land and building, and we will make those that color, kind of bluish. Okay, so we're gonna have asset is putting an additional 10,000 onto the land. I'll clean this up in a second. And oops, 20,000 onto the building. And there's one more asset. What is it? We're gonna sit in awkward silence until someone comes up with the last asset we need to put on.
The equipment,
I think this
we
is,
got inventory. Hold on,
I'll give you a hint. It's a good one.
it's a good one.
It's the one I always forget. It's goodwill.
Oh, okay.
Yeah, and it is, it's one of those ones that even though you calculate it, it's like, okay, wait, well, I just forgot what it was, 25,000. So this will be 25,000 for goodwill. Oops. Okay, and so we are going to take that out of our investment. That's not right, is it? Yeah, it is right. Okay. So, so far we did our stock, getting rid of the stock of the subsidiary. And we did the assets. Okay, so and then that's what we did before. The only difference here being is that we're taking out the beginning assets because the beginning assets are now in the retained earnings section. Scratch that. The beginning retained earnings are in the and then the retained earnings section. Okay, so now we got to start unmixing the cake and we got to go to the dividends. Now, if you recall, dividends were the wacky one. Dividends were the ones that reduce the investment. So when we reverse everything out, we have to unreduce the investment. We have to back out what we did for the dividends. So for dividends, we're going to, oops. Those are kind of wacky in that we add them back in because we're kind of unmixing the cake here. We took out the dividends because we said, okay, we get paid dividends, we're no better or worse off. And, so we reduce our investment. Well, now we're going to reverse that out. Where is it? Okay. So dividends actually are the weird one that they get added into the investment, even though we're getting rid of this investment. Okay, so we got dividends, and now we come down here to my strangely spaced. Income. All right, and so we have to get rid of the income here. Okay, so we have 19,000. Oh, I didn't pick a color for it. I jumped here, purple. Okay. So this is our investment. There's our income, but being taken out of the investment. And the last one are the additional expenses. Okay, now we have to go up here a little bit and okay, land does not depreciate. You know, the building eventually is going to crumble to the ground, but the land underneath it will still be there, so we don't depreciate land. But this building, we do, and we have an extra $20,000 in the building, and it's going to last for 10 years, so we have to depreciate a certain amount every year. Okay, so building. Yeah. Okay, so building. We have an excess of 20,000. And we're going to divide that by 10 years. And that's going to equal 2,000. So this will be our additional expense. All right, now this one is a little bit strange for a couple of reasons, but first of all, it's going to be additional what depreciation expense. Where am I at? So this is E. Oops. E. We're going to have to add 2,000 to the expenses. This one is not going to go with the investment. This one is going to go with the buildings. We are writing down the buildings for 2,000. Now, eventually this $20,000 excess is going to go away. After 10 years, it's going to be gone and we're not going to do this anymore. But we're going to add 20,000 to the building, but we're also going to take 2,000 off because 1 year's gone by and it's going to last for 10 years, we believe. So we have to decrease the value of that building by $2,000. If this looks strange, it should. This is the first time you go through the, we're gonna go through a few of them though, so. But yeah, so this is, I don't know if those colors, if they add or detract from what we're looking at, but anyway, so the expenses. So when it comes to, the dividends and the expenses are a little strange. The dividends are strange because they actually add to the investment. And the expenses are a little bit strange because they actually don't have anything to do with the investment when you're doing the consolidation. They're being expensed and taken off of the asset, just like you'd normally do. It's like a normal journal entry for depreciation expense, you know, the depreciation expense, and then the accumulated depreciation will decrease the value of the asset. And you'll notice that these are both at net, which means the depreciation is being taken out of them, the building and the equipment. We don't do anything with the equipment right now, but yeah. All right, well, let's start squishing these things together. All right, so consolidate those. So we're going to take the revenues from Bill and the revenues from Amy and add them together. For the rest of these, it's going to be a little bit different. And I'm going to put this into like how you normally see the financial statements where the cost of goods sold will be negative. You can also leave them as they are, but I'm going to put them in as negative because they are costs. They're money going out. Okay, so that plus that. Depreciation expense. These are also negative. They're expenses. And then we also have this expense. Any amortization expense. So that's 0. The equity is, you really don't have to do this, but 19,000 minus 19,000. You know, this is a credit for 19,000. This is a debit for 19,000. And this is really good because I don't know what color should we make those. I think I'm missing a color. What color am I missing? Blue. These two should be exactly the same. And they are, which is good. So those two are exactly the same. We've wiped out the income for Bill Company. Notice that the income was already accounted for in Amy Company to get the 79,000. You know, here's the equity income. And you might say, well, wait a minute. Why is the equity income that we have listed on the books on Amy Company 19,000? Why is this 21,000 for Bill? Why do we have this difference? Bill said their income was 21,000. We say it's 19.
Perhaps it also has to deal with the purchase of the company or the consolidation of the company, the time it was consolidated. Because if it was consolidated at the beginning of the year, then meaning Army is not going to take part in Bill's net income.
Yeah, it does have to do with the year. It's for this 2,000 of expense. But yeah, it happens over the year that this, what is that? Is it equipment? That's not equipment, it's a building, right? That the building's gonna go down by $2,000 over the year. So we say, okay, it's 21,000, it is 21,000 for their income minus this additional expense we have to take. So that's why we got 19,000 on the books, whereas they have 21,000. We're depreciating more out of their building because we added it to it. Okay, so here's what's gonna happen. So coming down here, our beginning retained earnings now. Just to tell you, just to give you a heads up, jumping ahead, we're basically gonna only have the parent company's retained earnings left. And I'll kind of go through and explain why here in a second, but these are the only thing that's gonna be left. So we have the 350,000 plus the 65,000 minus the 65,000. This is gonna give us our beginning retained earnings, which is just going to be these. As a matter of fact, you can just copy those all down because this 21,000 doesn't exist anymore. We wiped it out up here with the 19,000 and the 2,000. This is gone. The dividends are 60,000 plus 5,000 minus 5,000. And the ending retained earnings will be the same too. I'm going to put it on here as just kind of show you what it would look like as positives and negatives, but this net income is gone. The only thing left is that. The dividends are going to be negative. 65,000. And if I add all these up, you just copy them over too, though. Yeah, it should come out to this. So these are going to be the same as these. The retained earnings for bill company are gone. There is no equity section there. There's no outstanding stock there. We should take a break. I want to finish this up. We'll take a little bit later break. We're almost there. Okay, so let's go down to balance sheet. And I'm just going to add these up coming over. If you add in the debits and subtract out the credits over here, should be able to copy these down. Missed one. I'm gonna check these just to make sure. I'm gonna take the building just to make sure. So we're gonna add 120 plus 45 plus 20 minus 2. It does. Okay, these are the right numbers. Okay, so 76, 90, 195, 170, and again, we don't write down that land. Land just sits there like a lump. The building, we wrote it up by 20,000. So 120 plus 45, an additional 20,000 added on to the building. But now we depreciate 2,000 of it because we think it's gonna last 10 years. Don't forget about the equipment, even though it didn't do anything wacky, it still is it's an asset. Okay, now for the tough one. We're gonna take the 239,000 plus 5 minus all those. So plus 5,000 minus. Hey, that's exactly what we want to see. It's gone. Oh, Let's not celebrate just yet. We have one more. I'm amazed I haven't forgot that. I almost forget the goodwill. And I sit here looking at the screen. Why don't these balance? It's off by 25,000. Why? All right. So add all these up, and this should be our total assets. By the way, yeah, I told you before that when you do the consolidation, it'll look like this. You know, if you consolidating financial statements, they'll just look like this. They'll be like, this is consolidated financial statements for Amy.
That's right.
Yeah.
Back as to how you got zero for that, like what's the formula that you did?
This?
Yeah.
Yeah, so so these are debits. And you'll notice that, let me bring these down. I thought, I think those must have fallen off somewhere. Okay, so this is a debit. This is going to add to it. So so the debits will add the debits together, and they're going to subtract out the credits. So these guys are going to be debits and credits are going to be the debits will be adding to this, and the credits will be subtracting. So 39,000 plus 5,000 minus all the credits, and it should come out to zero.
Thank you.
Yeah. Yeah, that's a good question. Yeah, so the debits will add to it and the credits will subtract from it. And again, the weird one are those dividends, because originally when we got the dividends, we subtracted it from the investment. Now we're going to put it back in. And you'll notice that that cash we got is somewhere in this 50,000, you know. Yeah, this cash is lower by 5,000, but this is higher by 5,000, and it doesn't really matter as far as the consolidation where it's at. That's why we don't really think too much about dividends coming from a subsidiary, because it just means that your subsidiary has less cash and you have more cash in your company. Okay, yeah, so this will be all right. Now coming down here, this is similar to what we had up on top there, in that we're going to add up the two, excuse me, the liabilities. Amy owes 70,000, Bill owns 25,000 accounts payable. And the bonds payable 110 plus 65. And by the way, these are almost always at fair value. The liabilities, just the accounting rules in general, means that whatever the fair value, usually those are at fair value. Excuse me. Now, this equity section is gone. This 81,000 doesn't exist. We took that out up top. All this is gone. The only thing that's left are these. Oops. Try that again. And that's the only thing we're going to have over here. The only thing that's left are the parents' equity section. The subsidiaries' equity section is gone. So this is all gone. And even though we don't have it down here, it was eliminated up here. This is not included in the retained earnings. Okay, and we will sum them up. Yay! Okay. There's no map. That's the first time through. If it looks confusing, it should. It's the first time we've done this. And again, when you do the consolidated, so if you see a company has consolidated financial statements, for instance, for Ford, if you look at Ford's financial statements, they'll have Ford Motor Company. And then they'll also have to put out consolidated financial statements. And those consolidated financial statements will look like this. They won't break them out. They'll just say, okay, here's the consolidated revenues, here's the, blah, 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 all the way down here. And this is what they'll show for the consolidated. These journal entries here, these consolidation entries, these are put on the books. They run the financial statements and then they reverse them out. They reverse them out, put the investment back on the books, and start the next year. So these get reversed out every year. They get put in, run the consolidated, and then they get reversed out. Okay, I'll leave this up. Let's take a break. I'm gonna go build a campfire. It's so cold in here. So let's say be back at, what time is it? 7:10. Let's say be back at 7:20. And I'm gonna go get my coat. All right. Okay. Make sure I'm, hello. Coming to you from Alaska.
No,
Okay, it's freezing in here. All right, let's see here. I gotta share my screen. Okay, let's go to problem 3. Okay. Uh-oh, look at your mean teacher. Look what he did to you. All right, well, we can use this one over here to kind of figure out. Maybe be able to copy that, I don't know. In the formula. Those are formulas. Okay, let's see. So it's on 23. Okay, so let's see here. We're going to. So I can make that back into a little box. And so the total assets at fair value were. And then we have accounts payable and bonds payable. Yep, I'm gonna put those in as negatives. So these are the liabilities. Okay, so let's see, excuse me. Cash price paid was $360,000. The net identifiable assets were 320. So the goodwill is, oops. You know what?
40,000.
Yep, 40,000. Okay, I think we just jump in then, right? Yeah, let's go ahead and just jump in. All right, so, oh, I need Sadie. Where's Sadie? There we go. It's bugging me why Sadie is off center here. I don't know. It's it must be some kind of a ghost formatting or something that I got in there. Okay, well we'll just live with it. Sadie, so we got to get rid of the stock. And the tricky part to it is that the retained earnings we're going to take from the beginning retained earnings, which are up here. Okay, so this will be coming down here. And we're trying to get rid of this investment. Trying to get this off of our books because we don't want to count it twice. Okay, so that is the stock. And again, this is taking it off of the books. You know, this is a debit for the investment. We're crediting it. Assets. Well, the assets we have 16 and 32,000 for land and building. And one more. What's the other one we need? Don't be a mark and forget it. What's the other asset that we need?
Goodwill.
Yep. Goodwill. So, oh, what was it? 40,000. It's not in the right spot. Give me a second. All right. So we have these that we have to take off of our investment. Excuse me. Okay, dividends. Dividends are the kind of strange ones in that they actually get added back into the investment because we took it, we're kind of like unmixing the cake. Earlier when we recorded these, we took it out of our investment. So this is kind of the strange one that we put it back in. Okay. I. I is for income, and we come up here and we have investment income of 30,000. We have to take that out. That's a credit for 30,400. We're going to debit it. Okay, and last, let's do the expenses. Okay, land is not going to do anything. Building is going to last for 10 years. So we'll have Sus. Oops. Again. Building. $52,000. Divided by 10 years. Equals 3,200. So these will be additional expenses or additional depreciation expense. So this will be, is that right? Okay. So this one is a little bit different than the other ones in that, excuse me, we're going to add it up here to the expenses. Oops. Just that quick, I forgot. 3,200. Ooh, a little too much there. Let's go back. Okay. Now we've already taken the income out, so this is actually going to go and take out some of this building because it's no longer plus 32, it's 32 minus 3,200. 32,000 minus 3,200. Okay. And by the way, on the CPA exam, they may ask you something like, what would be the ending balance in the building account? You know, they may give you a setup, you know, something like this up here, and then ask you a few questions on it in multiple choice form. And one of them would be a good one would be, what is the ending balance in the building account? You know, they want to know that you add this on and then take off 3,200 of it. All right, well, let's start adding these up. Okay. Revenues. Cost of goods sold, and I'm going to put that as a negative because I'm very negative, because it's negative degrees in this classroom. My family is from northern Wisconsin, and this is what it feels like in northern Wisconsin. Hey there, let's do some accounting, babe. All right. Depreciation expense. Don't look right. 32. Yeah, it is, that's right. Okay. Well, these will just be zero. This is zero because we don't have anything there. This is zero because our equity income was 30,400. Notice that should be also included in this up here already. So we've taken that out. So 30,400 minus 30,400 was zero. And hopefully this comes out to 126. 400. Yep. And it does. These two should be the same. Because it's already included in here. And we're there 33,600 minus the 3,200 equals 34. There is something actually, there is something I want to talk about in the books. which is kind of a crazy thing. I'm not sure why it's there. And that's just down here. If you do get the book and you're reading it and you're wondering what the additional C, they'll say SADI C. And it shows the additional C is for the accrual basis for consolidation using the equity method to account for the subsidiary. No accounting for the subsidiary has been done, which is crazy. You know, these are operating like separate companies. How can you get a check for, and put it in your bank account and balance that if you don't have any journal entries on it? But I'm not sure why they say that, but I've never seen anyone that didn't do this by the equity method. I don't know why they would. Okay, let's do the retained earnings, and we're gonna do this the quick way. It's always gonna come out to be just the parent's retained earnings, and why there are no retained earnings here anymore. The income's gone, the beginning is gone, the income's gone, and the dividends are gone. So there's nothing left here. So it's just gonna be the parent company. I'm gonna put the dividends in as negative, just because that's why you would normally see those on the statement. And they should still add up to the 5, and they do. Okay, so this is that. So the only thing that should be left in the retained earnings are the retained earnings of the parent company. Okay, coming down here, it gets a little bit tricky. These are all debits. Add those. If there is anything in this debit column, add that and subtract any credits. Make sure I don't do something stupid. I'm gonna go ahead and I'm gonna do the buildings account just to make sure I didn't do anything wrong. $292,800. Okay, that's fine. Okay, now for the tricky one, we're gonna take 382,400 plus 8,000 minus these credits, and that should come out to 0. Plus, minus, minus, minus. Yay, it's 0. Oop, don't forget this one. And by the way, if you ever come up to these total assets don't balance, make sure that here's the two that get missed. And I think this one gets missed because it's just where it's at. Equipment, sometimes people leave this one out and it doesn't balance, and goodwill. That's the other one that gets left out. So if you do come out that, hey, my total assets don't equal my liabilities and equity, check those two, equipment and goodwill. Okay. And down here as up with the other stuff in the equity section above. These will just be the parent companies. The only thing we left with the parent companies, their outstanding stock, paid in capital, and retained earnings. Those are the only ones that still exist out on the market. Yay, they balance. What's that matter? I'm gonna give you guys problem 4 to do as homework. I think we're gonna call it a night here. Yeah, we'll call it a night here. So try problem 4 on your own. And if it doesn't balance, check these two. These are the two that get missed the most, the goodwill and the equipment. I think the equipment is just because I put it in kind of a funny spot here. Oh, not a funny spot, but this is usually the way you see it on the financial statements. But yeah, I think that one's just, it's positional. You know what's kind of strange about the balance sheet is for the current assets, we go from the shortest lived to the longer lived, you know. Cash receivable inventory can be on the books for longer. It goes just the opposite as far as property, plant, and equipment. We take the longest one, put the longest one on first, and then go to the ones that are less, you know, the building, and then even less than that are the equipment. But anyway. So yeah, any questions? You guys okay? All right.
All good.
No questions. Thank you, Professor.
All right, guys. Well, yeah, I will see you next week and try to give that one a share, and we'll put the answer up next week at the beginning of class, and then maybe we'll do number 5 together. You can try number 5. If you get number 4, you can go ahead and do number 5. We'll see. And then next week I'm gonna have a couple of textbook problems, and then probably do a review before they send out the exam just to make sure. But anyway, we'll worry about that next week. So yeah, go ahead and see if you can do number 3. And if you can get number 3, if you don't get it to balance, look at the equipment, which is commonly overlooked, and also the goodwill. All right.
Okay, thank you. Have a good night.
I'm gonna take my snowmobile home now. So, all right. See you guys.
Bye-bye.